Balloon payment dangers, refinancing options, and timing. A balloon payment can quietly become one of the most dangerous risks in real estate financing. Now, whether you're a homeowner or an investor or a business owner, a balloon mortgage requires strategy and not hope alone. And at Medallion, we regularly help clients refinance balloon loans before they become financial emergencies. And the key isn't just refinancing, it's refinancing at the right time. And the trick to that is preparation. So let's break this down a little more clearly and let's help you prepare. So, what is a balloon payment? Well, a balloon payment is typically going to feature some of the following. So, you'll generally have a lower monthly payment for, say, 3 to 10 years, and then a large lump sum payoff is due at maturity. And that's often structured as an interest only or amortized over 30 years with a shorter term note. The danger in that is that when the maturity date arrives, the entire remaining balance is due. And that's how a lot of banks call their notes and recycle their capital, is kind of the point behind that. But if you can't refinance or sell at that particular time, you could face a default risk. Call me before you get a net OD. Why balloon payments are dangerous? Well, there's market risk. If rates rise before maturity, refinancing becomes more expensive. There's potential property value risks. So if the values decline, loan to value ratios may exceed what they can do on a refinance. So you could put yourself in a pickle. There's also cash flow risk. And this is really for investment properties. And if your debt service coverage ratio weakens due to maybe vacancies or rent compression, lenders may decline your deal altogether. And four, there's liquidity risk. So lenders evaluate reserves on their principal sponsors. And limited liquidity can make it difficult for banks to get comfortable with approving a refinance. Balloon loans are going to require proactive planning and not last minute scrambling. So when should you refinance a balloon loan? Well, best practice here is to start at least 12 months, if not up to 24 months before maturity. And the point is, you don't want to get caught behind the eight ball. And here's why timing matters. You preserve leverage flexibility by starting earlier. You could avoid distress rate scenarios by starting earlier. And you maintain better negotiating power with banks when you don't have a timing deadline. And helps reduce underwriting pressure to get the deal done. But waiting until the 90 days before maturity significantly limits your options. Not to mean it's not doable, but let's set you up for success is the point. So let's look at refinancing options for balloon mortgages. And residential balloon refinance options could be conventional rate and term refinance, an FHA refinance if it's an eligible property type, or a cash out refinance. Or you could use the bank statement loan for self-employed borrowers to take out the financing. Or it could be a DSCR loan for an investment property. Now let's take a look at some commercial balloon refinance options. So there's conventional bank term loans. There's debt fund DSCR commercial lending. There's also SBA 7A and 504 refinance options, which have more credit flexibility. There's also bridge loans with planned exits. So it has to be a scenario that makes sense and they're going to get their money back. Or it could be a portfolio lender refinance with a blanket type option. And really the point is each option is going to depend on the overall loan to value, what you're proposing, and the debt service coverage ratio on the loan amount you're requesting, but also your global cash flow, your liquidity reserves, and also your credit profile. And this is where working with a mortgage broker is going to provide a strategic advantage for you as a client. So what are some signs that you should act now versus later? Well, if any of these apply, it's likely time right now to evaluate your balloon refinance strategy. So if you say yes to any of these, please reach out. If your loan's maturing within the next 24 months, if interest rates are trending upward, if your DSCR has tightened, gotten lower, or if you've recently improved the income or the rents on the property, it might be time to look at it. And if you plan to sell within 3 years, we need to structure that around that so that's not going to hinder you there. And the point is, the earlier you act, the stronger your negotiating position. So let's look at a strategic refinance versus an emergency gun to your head type refinance. So smart borrowers are going to refinance early is the takeaway. But reactive borrowers refinance when pressure is applied. What that difference can mean is it could potentially result in lower rates or better loan terms or improved amortization. And it could end up in a stronger exit strategy for you. So at Medallion, we're going to structure balloon exit strategies with the end in mind and not just your next payment that's due. So let's look at some final thoughts for the day. And the point here is don't let the clock control you in the process. So balloon payments are not inherently bad. It's just the way commercial lending works for the most part. But what it does mean is that they're going to demand that there should be some planning ahead of time, some monitoring going on, and working with a mortgage broker so you can work on your strategic timing and also to gain some capital market awareness. And if your balloon note is coming due, don't wait for the urgency to dictate your options. Refinancing should be a strategy and not a reaction. That, my friends, is it for the day. Please visit my website, billraponline.com. Love to talk to you more about your situation. Have a good day.